Welcome back to this financial podcast. It is July 23rd, 2018, and I'm looking at a really interesting opportunity here in the stock market. And this is not just a short-term opportunity, it could be a long-term opportunity. It depends what your goals are and how long you want to hold on to an investment. And I just saw a stock recently. It has made a very interesting move here, and that is AT&T. This company has been a lot in the news lately. They have been making a lot of acquisitions. They purchased Time Warner. Now, the government challenged it based on antitrust rules, and they lost. AT&T prevailed. The judge ruled in their favor, and the merger is going to go through. Now, the Justice Department wants to appeal it, and I think it's a bunch of nonsense. It's a huge waste of taxpayer money. A lot of lawyers looking to make money in Washington. It's all politics. It's ridiculous. They're going to lose. They're not going to win this appeal. People are saying that they could win. Look what will happen with Whole Foods and Wild Oats. Well, that is a joke compared to this merger. This is a mega merger, and there's a lot behind it. And I don't think that this is going to happen, the Wild Oats thing with Whole Foods. Anyway, Whole Foods was glad that it was appealed, and they didn't even want the merger. It wasn't going to help the company. It wasn't going to augment the company, so they were actually glad that the appeal was won, but I think that's the only time that they prevailed. And of course, this merger is not a horizontal merger, it's a vertical merger, and they have to come up with a appeal that's going to refute something else based on what the judge already ruled on. So it's going to be difficult. They can't appeal the same thing. They can't appeal the same rule. They have to come up with some other reasons why this merger shouldn't happen. Anyway, I see a very interesting opportunity here, because if you look at this company fundamentally, I'm not going to get too much into fundamentals because I really want to talk technicals, but fundamentally, this is a very, very good thing for AT&T. Now, they did take on a lot of debt. I don't like that, to purchase the company, and all the other acquisitions they're making. They just recently purchased some sort of an ad program company that is going to help them make money with ads online, so they purchased that. They're doing a lot of acquisitions. The company's huge. It's by far now the largest telecom company in the world. The great thing is that the purchase actually complements their other businesses. It's not like they're buying businesses that are unrelated. I mean, look at Procter & Gamble. It's a great company. But if you look at a lot of the things they have, they're not even related. I mean, they sell razor blades and then they're selling cereal. Those are two not related things. The companies they're buying complement each other. You see, they have wireless services, internet, and media. And when you're selling wireless services or cable services, you want to have something to deliver what you're selling. Like, if you're just selling service, internet service, all right, you make money on monthly payments to pay for that internet connection. But wouldn't it be great if you could sell the connection and also deliver things over that connection? And that's what helps the company now that they're in media. And they have other businesses too, but those are their three main streams of business activity. And now they can complement each other. You know, you have one customer, he buys a bunch of things, you give him a discount, then you have upsells of those individual services. They can make more money. It consolidates things, it makes things easier, less customer service. If you're dealing with one customer buying more services, then a lot of customers just buying one service. And then retention is great. They have a lot of retention. You know, these are businesses that just continue to make money every month. There's just money flowing in. So it's not just getting new customers, it's retention. Retention is also important. So they have this going for them. What's also very interesting is that, you know, they were talking about the yield. Of course, people talk about AT&T, the yield. The yield is almost at record highs right now. I mean, the highest it was, ironically, I'm going to get into this, it actually exceeded 7%. And that was in 2008. And that's right. They actually raised their dividend that year. What does that tell you about AT&T? They raised their dividend in the worst recession since the Great Depression. All right? And they raised their dividend that year. You know how many companies cut their dividend? Forget about leaving it flat. Cut their dividend. They raised their dividend that year. So it gives you an idea how solvent they are and how safe they are. Not many companies can do that. Companies were just getting hit so hard. Many went bankrupt. And they're raising their dividend. So you have a chance to lock in 6.13% right now. That is a massive dividend. and they'll likely raise it after that. So that's something very important. That's what I mean about the long term. If you can lock in a dividend like that, that's incredible. So they're talking about, why is the company getting hit so hard? It's down around 19% since December. I mean, that's a very big move for a company this stable to go down that much. So why is it going down that much? Well, there's a few reasons. They're talking about the yield on the 10-year, right? That's pretty high right now. So they're saying that's competing with stocks. Yes, it is competing with stocks that are offering around a 3% yield, which is still considered high. But you're talking about a company that's offering a yield right now of 6.13%. That's far higher than the yield on the government bond. And now they compare it to government bonds because they're considered the safest. Well, AT&T, I think, is also pretty darn safe. 34 straight years they raised their dividend. I mean, that's what they call a dividend aristocrat, I think. And then at the same time, it's very high. It's much higher than those dividend aristocrats. There's no company that pays a dividend this high that I know of, not even close, that's been paying consistently every year, even in bad times. So you could lock this in. I mean, this is an incredible return. Now, for the short-term investor, you could be looking at a big move right here because, like I said, fundamentally, I mean, if that's only all the bad news that they have, is the fact that the government appealed the Time Warner merger. I mean, I don't think they're going to win it. A lot of people say they're not, and I agree. And then, of course, they're saying they put on a lot of debt. Yes, I agree, that's a problem. Debt is not good. But when you purchase a company like Time Warner, you're going to have to pile on debt in order to get that company. But if your cash flow far exceeds your debt, you should be good to go. And don't forget, you have Time Warner, which is a cash cow. That company is going to continue to make money. I mean, they were making money. They were doing well before the merger. It's going to complement their businesses. They can consolidate. They can put their business together, offer package deals to customers to get their internet service, their cellular service, and their media. I mean, it's just industries that are related. And I think the company is going to rally from here because the dividend is just too tempting if people to ignore a company like this. So let's talk about the technicals. Now, if you look over here, there's a chart of AT&T. You can see this is like a triple bottom. I mean, all the way back in May, it went into the 30 range, and then it really started to rally, came back down again. Here it hit around 31, and then rallied, came back down again, and now it's at 31. That's a triple bottom. However, what if it goes through? But that's still a strong support. You know, we're talking about almost 3 months of a support level that it's holding. So what if it breaks through the support? Okay, so let's look at another chart here. Now this is a weekly chart. Now if you take a look, you can see that the support is really strong, and it's really strong at around 30. I mean, you can see here, the last time it was below 30 was way back in 2016. So this company is zigzagging along, and this is what a company this size does, and a company that pays such a high dividend does, because people are buying this for dividend income. They know it's a very safe company. They know that they raise their dividends on a yearly basis, and they're looking for income. So it's people that are holding on to the stock. But when the stock gets quite low, it starts to bounce. And if you look here, here's where we are right now. If it gets here, it's likely that it's going to bounce back up again. So you could be looking at a nice short-term gain and at the same time grab a piece of that dividend. So I think it's a good opportunity to look at this company right here. I think it has a combination of a lot of things. Some upside potential, nice dividend. It's a very safe company. So you have all those things going for you, and you could be looking at a nice move. Even in the short term, it could be a nice investment. I would say a good place to get in here would be around the 31 level. I mean, if you get in lower, it'll even be better. Your yield will be higher on the dividend. So I would say an entry would be 31.10 or better. It closed on Friday at 31. I mean, if it goes down, you got a nice dividend. The company's paying you to hold on to it. So it could be a good opportunity right here. So I would like to know what you think, and to make sure to find out what's coming up next, especially concerning this particular trade, make sure to subscribe. Feel free to leave comments. Please like up this video, and thank you for tuning in.